But the second point is on edible oils. Yes, since mid-September, there's been 20% additional import duty raised, and that's going to lead to a slight threshold shift in food inflation numbers now for the next 12 months. But on the vegetables front, the next point and most important that I want to pinpoint, see, currently vegetables index, even in this reading, it spiked to 292 levels. In line with our expectations, we were at 6.15 for the in terms of the number, 42% vegetables inflation, exactly in line with we thought, while the headline is slightly higher at 6.2. But the important point is, on a seasonal basis, in the coming months, by March, this 292 level of 42% YOY inflation is likely to ease off to around, even if lower, not falling as much, but at least around 195 to 200 mark. In fact, historically, in good monsoon years, the numbers would go down to as low as 160. So even if vegetables inflation moves down from 42% to zero by March, 6% weight, that only gives you a delta of 2.5 percentage points, which is why CPI ex vegetables at 3.63% matters. So there'll be a convergence of headline towards CPI ex vegetables as vegetables inflation starts to correct. Just one more point from my side. Maybe in the short term, vegetables inflation still stays elevated. It does not fall as much because it seems now after tomatoes, it's onions giving us inflation tears in the month of November. So our forecast for even November is close to 5.7 to 6, depending upon now how onions inflation pans out.
Sure.
But just this cooling of vegetables inflation can lead to quarterly CPI forecasts moving towards MPC's 4.2% by March quarter, even though in December quarter, while MPC is at 4.8, our number is tracking closer to 5.5%.
Yeah. Okay. No, I take your point. That's an elaborate explanation of how we cannot expect too much of a fall off. Devang, let me liberate you from the pain. It's not going to make much of a difference to the market, isn't it? Whether it is going to be 5. I think the market was prepared for 5.96. At 6.2, will it make a difference, or will you all still only look at the US?
No, so I think you're right, Latha. I think probably we are more looking at what's happening on US bond yields. Obviously, there is a near-term worry on Indian bonds also, because in the last 30 to 45 days, our bond markets haven't reacted to the up move in US yields. So US yields from its bottom are up now 60, 70 basis. Our bond markets haven't moved by more than 3 to 4 basis. Except for soft market in India, nothing has moved up. So I think some pressure on currency. It's been now 45 days. FPIs have been selling in debt market in India after 9 months of inflows. So near term, we can see some uptick, but favorable demand supply dynamics on bond markets, and I'm sure everyone will be tracking US inflation tomorrow, will not lead to any major sell-off in our yields. Our yields will continue to trade in the band of 675 to 690 in the near term.
It's not even going to that. It's perhaps only at around 6.8. Okay, thank you very much, Devang. So it's not the market issue. It's going to be more how Reserve Bank looks at it. Nikhil, before I asked you when the Reserve Bank will plan a cut or easing, the growth number, the September IIP numbers coming in well over 3%. Is that going to be a relief? Will that make a big difference for you in terms of what you're expecting by way of a GDP number on November 29th?
No, Latha. 3.1% IIP implies that IIP growth was only 2.6% in the quarter ending September. Manufacturing sector growth was 3.1%, much lower than above 4% that we have seen in the previous quarters. And not only IIP, if you look at the company results that have been coming out, especially the consumption stocks, and generally, the growth has been coming off. So we were very clear, and we continue to maintain our view that manufacturing growth within GVA will come off in Q2. And I think Q2 GVA data or GDP data will be much weaker than what the market or the RBI has been expecting.
What's your number? Have you zeroed in on your number for the second quarter, or will you want to change it after looking at the results? And
no, we are not changing it. We still keep it GDP growth at close to 6.2% and GVA growth of 6.4% for Q2, which is much weaker than the market consensus.
Yes, you are weaker than the consensus. I've got a few readings which are showing more between 6.5 and 6.6. Actually, why don't I take that poll from the ladies as well? Where are you standing at, Sakshi, in terms of growth? Having looked at the IIP number, what's your GDP for the second quarter?
So I don't think, Latha, we are changing our call on GDP based on this IIP number. This is broadly in line with what we were anticipating. A lot of this, growth that we are seeing in IIP was, stocking up ahead of the festive season, and some of the disruptions that we saw due to rainfall in August, some of that easing off. In terms of GDP growth, of course, across a host of high-frequency indicators, it is visible that things have slowed down in the second quarter. And we are, as of now, working with a number of close to 6.6% for the second quarter in terms of GDP.
Okay. Kanika, your number?
So for GDP, Latha, we are at 6.4, 6.5. In fact, GVA may slip below the 6% mark in our view for this quarter. As completely agree with what Sakshi and Nikhil said.
Below the 6% mark? Sorry?
Yeah, GVA looking slightly below 6% for this quarter.
Okay. Now that's going to make a lot of people sit up. This is a little confusing, whether GVA is going to be higher than GDP or the other way around. I'm not able to guess the subsidy number at all. So it's a little confusing. But Devang, all said and done, if the GDP number is going below 6.5, that's something that will really rattle even North Block and New Delhi. So when do you see a Reserve Bank cut now?
So I think with this CPI print, and I think probably most of the panelists spoke about that, we will be significantly higher as compared to RBI projection on CPI. So I think December is out. February onwards, we see a very high probability of a rate cut in every policy. So Feb is where I pencil in the first rate cut. Our perspective is that probably this cycle, because it's just the beginning, and I think we have also started seeing some bit of high frequency indicators to slow down. In fact, corporate guidance was weak, earnings were very weak. So our perspective is that yes, growth should be lower than what RBI is expecting next year, and that would probably lead to rate cuts. But we are looking at a shallow rate cut cycle. We're not looking at too many rate cuts. We should probably think 50 basis in this cycle at this moment.
Okay. No, I don't. Irrespective of this inflation number, it would take a very brave central bank to cut in the face of so much of attack on the currency. I guess they will want the worst to blow over before they take an action. Nikhil, where do you stand on the matter? Do you think even February the Reserve Bank moves?
Latha, February, I mean, again, it's very difficult to take a call right now. We still are 3 months away, and there are a lot of things that could happen. First, we need to know how does the Trump administration works. If we get tariffs in the way that he has mentioned in his campaign, then things will get very difficult for any central bank. If he becomes as fiscal expansionary as he has mentioned, then the US growth would have some implications for the rest of the economy. But what I'm very certain about, and this is something we have been maintaining for long now, December is definitely not the case. February is still 50-50. I would not put too much probability on that, more than 50%. The only thing that has to happen, again, is something where we have been consistent. Growth has to weaken substantially. India's growth has to weaken. That is the only possible trigger for growth, for rate cuts. Otherwise, I don't think RBI has any reason to cut rates at this point in time.
I take your point, but if it comes below 6.5 and your number is 6.4, if it were to actually print like that, will that be sufficient reason for the Reserve Bank to move in Feb?
If they also revise their growth forecast in line with our forecasts.
Okay. Yeah, but they are going to revise their CPI higher, so you will have to take a call that you have given up the chase.
Exactly.
You change the entire narrative.
If let's say the growth consensus or the RBI growth forecast or projection for FY25 full year comes down to 6.5%, I think that gives them a reason, even if they revise upward their headline CPI slightly to 5% or so. 6.5% or anything below 6.5% could give them a reason to cut in February.
Okay. But there is a distance to travel to get the entire number down, the full year number down to 6.5. But you never know. Let's do one thing. Take a quick break. We'll come back and ask your growth forecasts and Reserve Bank action expectations in just a minute. Welcome back to this special State of the Economy show where we've been discussing the October inflation numbers that have sprung a nasty surprise at 6.21%. The CNBC-TV18 poll was 6. And until very recently, a majority of the economists were sitting a little south of the 6% mark. So 6.21 is at the upper end of the range of expectations we got. Food inflation is the bigger culprit at 10.87%. Vegetable inflation year on year at 42%. And edible oils as well, rising 9.5%, obviously because tariffs were raised on edible oils. Cereals inflation at 7% has also contributed to the overall rise in food as well as in overall inflation. I've been speaking with Kanika, Pasricha of Union Bank, Sakshi Gupta of HDFC Bank, Nikhil Gupta of MOF, Motilal Oswal, and Devang Shah of Axis Mutual Fund. Gentlemen and ladies, thank you very much for waiting on. Let me get the full year growth forecast from Kanika and Sakshi as well. Sakshi, what are you working with for a full year? What do you expect the Reserve Bank will say in the December policy? How much may they raise the inflation number to? How much may they lower the growth number to?
So, Latha, we are working with a growth number of 6.8% for the full year as of now. This inherently assumes that there's going to be a slowdown in activity in the second quarter, as we discussed, and perhaps some amount of stabilization that we might see in the third and the fourth quarter. I think the RBI will kind of recognize that, some of the slowdown that we are seeing in the high frequency indicators, and there could be a downward revision in their growth forecast from the current 7.2, perhaps closer to 6.9 or 7%. On inflation, I think clearly with this number being out and that pulling up the full year number, I would anticipate the RBI to increase the inflation forecast for the year to about 4.7%.
Okay. Well, there is a respectable body of numbers which will also argue that the second half, the economy may see a much better show. And I'll tell you what I hear from the more optimistic forecasts, that the Vahan data was very good for the October festival season days, those 28 days of festival consumption. The monsoon is expected to engender more rural prosperity and therefore more consumption. The government is expected to spend much more than it spent in the first 6 months when its capex expenditure fell far short of the year ago numbers. So, Kanika, do we really have to bring down the growth numbers so much? Do you think the Reserve Bank will stick with at least the 7% mark?
So, Latha, frankly speaking, there are two things. First is, of course, from 7.2, downward revision likely, but maybe they retain the golden 7% mark because as the governor himself is talking about, and you also pinpointed all the factors, after the second quarter weak show, third and fourth quarter, we may get back to the 7% threshold on growth numbers, on GDP growth numbers. But just one point that I would personally want to watch out for. In December MPC commentaries, see, there's a divide between economists and the RBI in terms of the outlook on growth or the underlying dynamics on growth. The RBI governor has been way more bullish, while all of us economists have been pessimistic even about the September quarter numbers. So while in the bulletin, they revised the number lower for September quarter to 6.8%, they remain much more bullish on the outlook. While sitting in a bank, we do see underlying dynamics, even from a credit perspective and overall economic perspective, showing some signs of slowdown. So want to hold on to my FY25 growth forecast, which is tracking now below 7%. It's closer to what Sakshi pinpointed, 6.8, 6.9, while the RBI may stick to 7%. On inflation, we are at 4.7%, but I don't think that's going to be a big worry for the RBI because the last quarter number for us is still tracking close to RBI's 4.2%. Thanks.
Okay. Well, point taken. The Reserve Bank has been more right than the street in FY24. If all of you remember, the Reserve Bank stuck to its guns. At 6.5, the beginning of the year, they were higher than the rest of the market. Towards the end of the year, obviously, the numbers surprised all of us, but it was still a number closer to the Reserve Bank's estimate. So we shouldn't take their optimism very lightly. The second half could be very good for the reasons I cited. Very quickly, your first rate cut expectation, Nikhil, when? I just want the month that you all are expecting. Nikhil?
February 25 or later.
Devang?
Basis.
Sorry?
February month.
February. Okay. Kanika?
February.
And
25.
Sakshi?
I want to say February, but I think increasingly with what's happened globally and the move in the rupee and the fact that we'll have a new
Yes.
dispensation, I think that's
Yeah.
something we need to think about. So I'm going to be out of consensus and say April.
Okay. Well, actually, what you point out is right. That's absolutely a different kettle of fish. The composition of the MPC, who comes in place of Dr. Patra, and if the governor stays on, all this can change the thinking. And of course, the global environment is an altogether a bigger jigsaw, which perhaps can move as the MPC meets. And by the time February comes, it's a very long way. So we don't know what the global tariff war will look like, and therefore what global inflation may look like. With the rupee at 84.5, there could be some seeping in of inflation because of a cheaper rupee as well. So maybe we shouldn't try to outguess too many months into the future. Thank you very much, Kanika, Sakshi, Nikhil and Devang, for parsing the inflation and the growth numbers. It's a nasty inflation number. The growth number is slightly better than expected, but it does put the Reserve Bank in a tight spot, with growth likely to surprise slightly on the downside, but inflation likely to surprise hugely on the upside. That's it on this edition of the State of the Economy. We go into a break and there's lots of news and headlines lined up for you. Other side of the break.